Global bond markets are flashing a warning. Sovereign bond yields are at their lowest levels in years as traders anticipate major central banks will soon begin another round of monetary easing. We want to talk about this with both of our panelists right now. Brian, let me start this. It's not just the United States which is on hold, but we have room to move. Japan does not, and their 10-year went negative. And Germany and the Europeans, I mean, the European Central Bank is kind of stuck. They can't cut. What do you do?
Just the fact that we're actually talking about a rate cut again, that is what is driving this nervousness in the market. And I'm looking at some of the action today. The financials, Citigroup, JP Morgan, Wells Fargo, those stocks are still under pressure. They're leading the way down. So I think we have to start getting away from the rate cut talk for the markets to stabilize, and we're not there yet.
What's really remarkable to me as well is not just the downward trend that we've seen in sovereign bond yields, but the fact that stocks, at least in the U.S., have held up pretty darn well this year. So we've seen this interesting divergence where stocks are going up, the 10-year yield continues to go lower, which seems to be telling two different stories. On the one hand, we're worried about the economy. On the other hand, are we not worried about the economy or just confident in the Fed's ability to be the backstop?
Well, Julie, you're talking about a divergence, and it's not sustainable. Right? In other words, something's got to give there. Somebody's wrong, either the bond market or the stock market, meaning either the stock market's going to go down or the bond market's going to rally. Right. Because, you know, those two, as you say, are pointing to two very different narratives going forward. And I mean, I think you could argue that the stock market's a little bit in la-la land, right? In other words, you know, okay, sure, going forward based on what exactly?
Well, could it possibly be, we're watching these huge flows into equities. Could it be that the small investor, the little guys and gals, are the ones who are going there, whereas some of the smarter money, or not necessarily smarter, but some of the bigger money is trying to get protected?
Well, they're already there, Adam, I would argue. Look at how the tech names have come off. The average investor has been programmed to think, dovish Fed, let me go back up the truck on Netflix and Amazon. Those stocks are still trading at very rich multiples. Those stocks could probably start to sell off now, too, as they should.
Well, and as you said, there are implications for the banks, of course. I think last week the banking index had its worst week in years as we saw a sell-off there. So it's interesting and telling that it's continuing.
You're not going to get any market stability, unlikely, until the banks stabilize.
Yeah, and I think, you know, there's still questions about what Jay Powell is actually doing. And, you know, was this huge break and change and turnabout earlier this year or not? And if it is, what exactly does it mean? In other words, is he saying, I think the economy here is weaker than most people are thinking? You
brought that up after the December surprise where it was like, what do they know that they're not telling us? And a lot of people, investors seem to be saying that. We're going to get GDP numbers this week, and we're going to find out just how serious is this potential slowdown, not only globally, but here in the United States. What are we really facing?
Yeah, absolutely. And, you know, I think it's going to be that going forward. And you know, I think it's a little scary that at some point we may get a major break. In other words, wow, actually the Fed has been signaling to us that the market and the economy especially is weaker than we think. And if we had only been looking at those tea leaves or reading what signs the Fed had been giving us a little bit more carefully, instead of wanting to believe the glass is half full, maybe it's not half full.
Yep.